Everybody, and welcome to Carbon Tracker's webinar today, March 2nd. The webinar that we're doing today is on asset retirement obligations, and specifically a portal that we're launching that's going to give information about asset retirement obligations at state level, company level within selected states, and also information about the financial assurance that's related to those end-of-life obligations. You may have questions during this webinar. If you do, please use the Q&A function, and we'll try and get those answered for you as quickly as we can. As you may have also noticed, this webinar is being recorded. And just as a brief overview for today, I'm going to start by talking a little bit about the problem of asset retirement obligations, the dynamics at play with respect to those obligations, and then why we've decided to put together a portal that will allow people to get more information about these than they already have today. I'm joined by my colleague Savni Markar, who's going to be doing a run through of the portal after that, and also my colleague and co-author Greg Rogers, who will be available to answer some of those questions in the Q&A as you have them. So let's go to the next slide. So very briefly, Carbon Tracker, we were founded in 2011. We focused very heavily in the first part of that decade on stranded assets. And that is essentially assets that, because of the energy transition, fail to generate economic returns that were expected at the time of project sanction. There's been a number of impairments in the oil and gas industry over the last couple of years. Some arguably not driven by climate change specifically, but also about by the pandemic that we've been suffering and the implications in the longer term that that's going to have for demand. So very similar to the kinds of things we see in an energy transition. And it's prompted companies to begin to think about end of life and how they're going to be adjusting to this new norm. Part of that, in the flip side of that, I should say, are stranded liabilities, and that's what we're going to be talking about today. Let's go to the next slide. And that focus, we were looking at one point at asset retirement obligations. How are companies accounting for these end-of-life obligations? What are they saying about them, and what do markets know about them? What we realized initially was that there was actually a dearth of information. On the one hand, if you looked at financial reports for many companies in the United States, you would see they would tell you the number of wells they had that were producing oil and gas, but not necessarily the number of inactive wells or idle wells that weren't producing any oil and gas at all, or were ancillary wells and might be used for injection, wastewater disposal, and other things, or might not. There was a lot of lack of clarity about the total corpus of wells that individuals companies have. The second thing we noticed was that a lot of people talked about wells as if they were uniform, as if the cost of plugging a well that was 1,000 feet deep might be the same as the cost of plugging a heavily pressurized well that's 10,000 feet deep. There wasn't a lot of differentiation between them. And furthermore, a lot of the information that was out there suggested that the cost of plugging these wells was going to be quite cheap, maybe $20,000, $30,000 for a single well. But when we looked into it and we looked at some additional data sets that had much more granularity, we realized that the cost could be far more. And some of the anecdotal evidence supports that, as well as some of the recent changes from some state regulators as they've looked to de-risk their own portfolios. So let's get a little bit into and this of course is why we wanted to talk about a portal that gives people more information about it. So to go through background on the asset retirement obligations. First thing you know is that companies have to plug and abandon the well, and they have to reclaim the well site to return it as best as possible to the state prior to drilling. So it's a legal obligation. It already exists, and it's a financial reporting obligation as a consequence of it. Despite having this, enforcement has often been lax. This is not to say that regulators aren't interested in it, but these haven't necessarily been funded. So what we see is we have inventories of wells that are marginal producers or not producing any oil and gas at all in virtually every state in the country. And because there isn't this enforcement, it also means that there's not a lot of incentive to actually plug the well. It's always more expensive to plug a well than to leave it where it is. And so you can understand the economic incentives for companies in a highly competitive industry. But despite this, and despite the fact that there is a legal obligation, you could stop there, plugging is needed for a lot of reasons. Unplugged wells leak methane. Those leaks can emerge over time. So you may find that the leak isn't there today, but it may be there as subsurface conditions or other factors cause the leak. There is the toxics issue, aside from the greenhouse gases and methane that we know about. And then there is the fact that the society itself is always changing. And so sensitive receptors are coming to these wells. And if they're not abandoned, they can pose potential problems there. And that's where you see issues of wells in urban areas that are quite expensive to plug because of that, or in ex-urban areas as we see urban growth and the potential issues, sometimes fatal, that can result. Let's go to the next slide. So in our view, in the analysis that we've done in our past reports, including $1 billion orphans most recently in September, is that this is a big problem financially. And that we would estimate that US onshore costs could be just under $300 billion for about 2.6 million onshore wells. Now, I think it's important to note that asset retirement obligations are not just for onshore wells. They're for offshore wells and infrastructure. They're for midstream infrastructure. They're for downstream infrastructure. So you shouldn't think of this as the industry's liability. This is a fraction of it. But nonetheless, it is an enormous sum. If we look at the history of the industry, okay, from the beginning, how many wells have been plugged and what kind of pace we would expect, it would take about 300 years to plug the remaining possibly 3.8 million wells in the country. So because these are end-of-life obligations, they come after the assets themselves have ceased to generate economic value. So in situations like that, one thing you want, if you're going to be left with the liability, is some kind of financial assurance that the holder of that liability is going to comply and not just leave you with the bill. The primary mechanism by which that financial assurance is given in the United States is the surety bond, which is something like an insurance company that offers to step in and pay up to the face value of the bond offered if the operator fails to plug and abandon that well. But when we look at the total quantum of financial assurance, in the total quantum of financial assurance that states and the federal government, states have, I should say, I'm not focused on the federal government in these numbers, it's about 1% of our liability estimate. And this is due to a lot of things, many of them structural, many of them empirical, I would argue. In terms of the structural limitations, one of them is blanket bonds. So companies are allowed to have a bond that might cover one well, it might cover 10 wells, 100 or 1,000 wells, okay? And the bond amount is the same. Since it doesn't scale, there's just, you can end up in situations with companies that have literally thousands of wells, sometimes tens of thousands of wells covered by a single bond. The second thing is that there is insufficient appreciation of the question of depth. Deeper wells are more expensive to drill, and we would suggest, the evidence also suggests, even though the curve isn't as steep as drilling, that plugging deeper wells is more expensive as well. Yet you don't see very many programs that appropriately scale the amount face value of the bond to the depth of the well. And the final thing is we have idle well programs, which seem like a solution, but unfortunately are not, because many of the idle well programs we see in the country don't impose full cost bonding, and therefore don't provide a proper incentive to actually plug the wells. They actually serve as sort of a mechanism by which you can indefinitely idle a well without plugging it, which is just bringing the risk, compounding the risk in one part of the overall system. As I said before, the result is always that it's in the interest of an operator to delay plugging as long as possible. You'll hear about orphan well programs, and the issue is that the orphan wells themselves are often the tip of the iceberg. So you may have a state like Colorado that has 200-something orphan wells in its orphan well program, but almost 7,000 idle wells that are in the idle well bonding program, for example. And the issue is, as we move through an energy transition, there's not going to be more money available to plug these wells. There's going to be less. And if those wells can't get plugged today, the situation is not going to improve in the future. Let's go to the next slide, actually. This leads to really the conditions for potentially a downward spiral. So as I've said, we've talked a little bit about the energy transition. That's not just something we talk about at Carbon Tracker. That's something that's being talked about during CERAWeek right now by major oil and gas companies. So it is a significant issue. As I said before, the bonds don't incentivize the closure. That means we're going to see a buildup of this risk. And who's going to inherit that? Well, if these wells aren't plugged, they're abandoned. They become orphaned. They go into the orphan well program. And beyond that, they're going to be the liability of the state. Now, in many states, the state is not technically liable to plug the well. But the reality is this: either they will spend the money to plug the well, or they will leave the well where it is unplugged. Okay, so they will carry the liability, and the landowners in the state and the citizens of the state will carry the liability, either in the form of the cost of plugging or in having to live with a potentially emitting, abandoned, unplugged well. That's why we think that states will eventually act to protect taxpayers. And that action is going to be accelerated by bankruptcies in the space. And this is an important thing to note here. Historically, when companies went bankrupt, oil and gas companies, typically another purchaser would come in and acquire the entire company, including its fleet of abandoned, idled, soon to be potentially orphaned wells. And they would sit on the company balance sheet. What we're seeing now are signs that that is not necessarily going to be the case, meaning that when a purchaser comes to it, they don't necessarily want to carry this liability. And as a result, they would like to work out some situation whereby they can pick up only the wells that are still have some productive, useful life. When that starts to happen, you're going to see, and this has happened, for example, in Colorado in the PetroShare bankruptcy, a small bankruptcy, but a sign of what might be to come. You will start seeing orphan wells go into the state's fund, and they're going to have to deal with it. And to the extent they have to deal with that, the question will be, are they going to be cleaning up this mess? Are they going to be forcing that on taxpayers? Or are they going to demand that companies bond up to an amount that's sufficient to incentivize carrying out the legal obligations that already exist? Let's go to the slide I have here at the bottom is just, the graph, we can go back one. I missed one thing. This graph at the bottom basically just shows how deep some of these plays are. And you will hear lots of discussion about orphan well programs and the low cost of plugging these wells. And surely shallow wells are cheap to plug. But the issue is when you start looking at the total vertical depth in a lot of these plays, it's about or just under 10,000 feet. This is going to be a different ballgame than your modern shale wells. Let's go to the next slide. And the shale is kind of a particular interesting and cautionary tale. So the first thing is that, overall, the industries had negative free cash flow even before looking at a lot of these closure costs. And about only 4% of the shale wells that have ever been drilled have been plugged. And there's other attributes of shale that we know could make this a bigger issue. So conventional onshore wells might have a very long tail of production, but we've seen higher than forecasted production decline rates for shale wells. And there's a question of whether, as these wells near the end of their economic and useful lives, whether people are going to be investing capital to refract these wells and do other things, or whether it's just not going to become worth it. And if they decide not to, then of course we're in a situation where we've got a well that no longer has economic value that needs to be plugged. Let's go on to the next slide. This is another reason why we think that states, must and will act to protect their citizens and taxpayers. That's right. So industry has no retirement savings at all. So when we talk about these bonds and we say they're worth 1% of the value of the liability, it's important to remember there's no money set aside to deal with these obligations today for the most part. This is something that's going to expect it to be paid from future cash flows, okay? And so that's something that unfortunately, is the thing we're worried about drawing up. The second thing is that we see that there are firms with less risky credit selling these on to companies that arguably are in a riskier position. So we're seeing concentration of risk. Sometimes in some states, in smaller players, in other states, with players that have a systemically important role in the state in terms of the number and percentage of wells that they hold. There's going to be a finite and shrinking pool of industry assets. And states are going to competing not just with private lenders in the bankruptcy context for how to allocate a pie that's insufficient to cover all the obligations, but also with each other. So there are going to be states that have fully bonded or better bonded their liabilities, and they will be in a better position via the ability to call upon those sureties than other states who have failed to take the necessary precautions, which is also a reason why we would see and expect that this will grow. The last thing is that federal bailouts, including in the Moving Forward Act that was in the last Congress that didn't pass, were essentially contained a quid pro quo, which was states, the federal government will give you money, but in return you have to fully bond these liabilities. And we would fully expect that that's the kind of deal that a lot of states will see as a potential off-ramp from what is otherwise a downward spiral on this risk. Let's go to the next slide. So as I've already said, we think that bankruptcies are going to accelerate bonding. This is a very complicated issue. I won't go into too much detail today, just to say that there are precedents out there that would require what's known as administrative priority for these liabilities, particularly in the Fifth Circuit. So that covers Texas. And so there are some cases where a state would be able to get its wells plugged first, but there are also many instances, and there is no bankruptcy code rule on this, right? No code regulation on this at all. But there are instances where that has not been the case, and that hasn't played out to the favor of the states. And so the basic lesson is, once you've gone to bankruptcy, it's too late to really address this. And if you haven't gotten the bonds in place, likely the rule "you snooze, you lose" is going to be applicable. Let's go to the next one. So essentially here, this is just explaining, and I won't go through this in detail, what we see as the risk of asset retirement obligation acceleration, ARO acceleration, that's going to be driven both by the rising real world economic risks, and then the impact that de-risking by states will have on sureties, for example, increasing collateral and other requirements on operators, given this real risk of having to close the wells. This is an important issue and shows that there needs to be a policy response that can address this. And I'll go to my last slide, I think. So what do you need to know? We think as a baseline, people just need to get the facts right as to what the extent of the problem is. And so that involves a couple of very simple questions. So the first is, what is it going to cost to plug all the wells in my company or in my state? Okay, whatever unit you want to be looking at, what is the expected cost? Right now, these are far underestimated in our view, but there are some states catching up. The second is, how much is there in terms of financial assurance to assure that those liabilities are paid? And so that's a last one. And the third one is sort of, what percentage of wells in my state are likely to be abandoned now or in the future? So obviously something that is a highly producing well is not going to be abandoned tomorrow, but there are large inventories of wells that are either marginal producers known as stripper wells, less than 15 barrels of oil equivalent a day, or wells that are producing no oil or gas at all, either because they're used as an ancillary well or they're just an inactive well. These are wells that are obviously much riskier, and so you need to be thinking about that in terms of how acceleration might bring those risks forward. And I'm going to close out there and just leave it to my colleague Savni now.
Yeah, so moving forward to more of like the technical portion, really our portal makes an effort to answer the questions that that Rob just mentioned regarding asset retirement obligations. And we really focus on the states with the most significant liability and bonding estimates data, and that's really highlighted here. Those states are really highlighted here in blue. And now looking at what our data really covers and what isn't covered. Our liability estimates are based on state well data. So this includes total well counts, well status, production type, production activity, as well as depth. And these are all sourced from the Inveris web app. We made it a point to exclude certain well statuses as well as basins. So this is canceled, expired permit, permitted, plugged and abandoned well statuses, as well as offshore wells in the state waters of the Pacific Ocean, as well as the Gulf of Mexico. And then just to provide a rough screen for orphan well liability risk, we also subdivided the state well counts into 5 separate categories. And so these are producing stripper wells, injection wells, temporarily abandoned, and then zombie wells. As well as bonding estimates, these are really the sum of these face value of all of the active bonds held by either a state or a company for the plugging of onshore wells. This excludes any blanket or any other bonds held by the federal government, as well as any other forms of financial assurance. And so this includes surety bonds. And then moving on to the next slide. Some of the limitations of our tools, as far as the liability tool goes, our cost estimates are really based on total vertical depth, TVD data for each well. So the instances where the wells have no depth information, what our model does is it applies an average TVD data, which is derived from the wells that are queried. And then, so for the states or operators with no TVD data available at all, the model does not calculate a liability cost estimate. Another point to note is that Inveris's well counts are either significantly higher or lower than the figures listed on the state database. And this is just because of varying sources in data collection, omission of certain well types, or just misclassification of well status. We also have some estimation uncertainty because our modeling is really based on the ordinary course of operations for plugging and abandoning wells within the industry. So really any deviation from that causes some flux in the outputs when using this tool. Our cost model also is focused solely on onshore wells. So it underestimates the liability at a state and company level. If the state or company has a significant potential offshore liability that really isn't accounted for in these tools. Also, another thing to note with our liability cost estimator tool is that there's a significant well count drop in Texas, and this is because of the variations in API numbers. And this is really just because of a review process at Inveris, which is again where we source our data. As far as the bonding data tool goes, the limitations here is that the estimator really only allows for the searching of individual companies within a given state. And this is really because operator company names are not standardized across state bonding databases. And then the data may not reflect current conditions. And this is really because the bonding data does not appear to change significantly over short periods of time. And so the data is not regularly published by these state databases or data sets. We also do not currently have plugging bond data for Texas, and we do not include states that use any other form of financial assurance without quoted dollar amounts. And so, for example, this would be like Ohio. Moving on to the next slide. So our portal really makes an effort to answer these questions, and we've provided them on the portal just to kind of create the narrative behind this data. So those coming to the portal might be looking to answer these questions. And then going forward here. So what you're looking at here is our first tool. This is our liability estimator tool. And if you look right here where the total's listed, this is the total liability estimate nationwide, which is again split into the 5 categories mentioned earlier. And so you can go through, look for your particular state. I'm going to go with Colorado here. And this is the statewide liability total for all operators. You can go through, I'm going to go with Occidental Petroleum if you're looking to choose for an operator. And so this is really the liability estimate for Colorado and Occidental. And then you can also look for liability estimates nationwide for one operator in particular, which is what I did here, nationwide total for Occidental. Moving forward. So this is our second tool, and it is our bonding estimator tool. So again, going through and choosing Colorado as our example, the bond amount there is the total bonding value for the state of Colorado. You can sort through by bond amount or by operator name, and then you can also go through and look for the particular operator you're interested in. So moving forward, so aside from the tools that we've provided, we also have a series of state and company profiles. And they really evaluate liability and bonding estimates on a state and company level. And we really showcase 3 significant points, and it's the top operators by expected liability in inactive wells, as well as the breakdown of the vintage of wells, and then total bond amount, total liability amount, as well as bonding ratio for these states. Forward. So in addition to those portions of the portal that I mentioned, we also wanted to profile issues in the news. And so right now, Colorado is undergoing a significant rulemaking. And so we've created a focus area on our portal to highlight this. And it really covers the blanket bonds in Colorado for the top 10 operators. And this is kind of what it looks like on the portal. We wanted to give you a preview of that. I think that was the last thing. So we'd be happy to take any comments or questions, just something for us to take into account for later iterations of this portal. I think that's it on my end.
Savni, thank you very much for going through that. And I don't know if we're going to be able to have live questions, but what I would like to do is just go through some of the questions that have been raised already that may be of interest. And you could see in the Q&A section we've been running through and answering some of these. There were some questions at the beginning about the database and the number of wells that exist. There are about 2.6 million wells in the database that we're using from Enverus. There is an additional 1.2 million wells that the EPA estimates are not in the Enverus database. And then there are a range of estimates through state level databases with state regulators. And in some cases, those may or may not include certain legacy wells. So before there was any regulation of the industry, private entities would build lists of locations of wells, and some of those legacy wells may be still there. There may have not been regulation around it. So there's a lot of uncertainty around it. Because we wanted to keep it consistent with a particular data set, the information in our portal is based just exclusively on the 2.6 million wells from Enverus. Good. Well, as Savni, I would see. I'm going to get to a couple other Q&A questions while looking for the hand raises here. So Jeremy asked if there's a way to delve into the details on any particular operator, number of wells, location, vintage status, etc. So there is a way, basically, in the current database to get, one of the 5 categories that we've created from the Enverus data that run from producing to zombie well for individual operators. So you can go through and get some of that information. But I think, one thing that we're also looking for is this to be a two-way street. Is there other information that you would like to have, that would break things down, maybe in another way that would be useful to whatever purpose you have? We're happy to consider that in a 2.0 version of this portal. Another person asked, do companies put aside funds for orphan well programs? Oops, I've lost the question. Oh yeah, put aside for the bond amounts, and does this vary by state in the United States? Basically, the way that the bond works is that you have the surety bond provider essentially says, okay, I will give you a bond for $150,000, let's say, for 100 of your wells, and in return you pay a premium to me, which will range between 0.5% of the face value of the bond to 2%, with 1% being a pretty good ballpark measure. So 1% of the face value of the bond every year, plus supply me with some cash or equivalent collateral that I have, which may vary widely. That may be 5-10%, that may be up to 50%. And so, but the company itself, aside from that collateral, which is reserved for the surety bondholder in the event of a default on the bond, they're not necessarily putting any cash away to deal with any of these liabilities. Okay, good. So someone asked, we're going to extend coverage to other states, and what percentage of all wells are covered in the database. I will, I think that's something we need to put up, is what percentage of wells are covered in the database. These are the largest states with the largest inventory of wells. So I would ballpark now, and I didn't do this. I thought about doing this calculation before this, but I didn't do it, to be honest with you. I think we're probably looking at over 80%, maybe close to 85%, at least, of the number of wells, onshore wells in the country covered in these 13 states. If there are states that are of particular interest to people, we would consider extending it. Part of it is just understanding the utility. There's certainly, some states we could do that have an immaterial number of wells. And you can imagine from a variety of viewpoints, if every operator in those states failed to plug the well tomorrow and they had to close, the state could probably still afford it. And so in those cases, we haven't really focused on it. It is more of a systemic issue when you're looking at the 13 states that we're talking about here. Someone asked, is it possible to access the database? Yes, this is live now, and we will send around a link to the extent we haven't, for this, to a link to the database. So there's a question, why are federal wells and bonding excluded from your tool? So to be clear, federal wells are not excluded from our tool. It includes federal wells. However, the Inveris data does not disaggregate between wells that are on federal land and wells that are on state land. So there's no breakout for that. Now, why are federal bonds excluded from our tool? Those are excluded from our tool because what you'll see is a nationwide bonding regime is the preferred bonding regime. And so BLM holds a bond, typically for a large company. You can buy one at state level or one, for individual states, or you can buy one at national level. But once you're in something like 4 or 5 states, the cheapest thing to do is to buy the national bond. And that's several $100,000. But the point is that even if you took the sum total of the bonds held by the federal government on that and gave them to each state, right? So they're actually spread across the whole country, but if you gave them to each state, it's not materially going to change the issue here. So you're still going to see states with 1 or 2% of the liability assured. And so rather than try and do an arbitrary calculation on that, we recognize it's not going to make a significant difference. And we're just noting that we have not included those bonds here. Good. So here's a good question that's a bit complicated. It says in Colorado, there are multiple well categories for abandoned, plugged and abandoned, temporarily abandoned, et cetera, as well as shut in. How are they categorized in your database? So every state pretty much has a different way of categorizing wells. And in fact, you even have levels of confusion like this. In Colorado, that like you're talking about, you will have inactive well bonds, but you don't have an inactive well status. And so you will have these bonds in different ways of differentiating between them. And rather than try and marry every state's regime together, we focused instead on the Inveris database, looking at this from a perspective of production. So, and well type. So if the well is, an injection well, it's obviously not producing oil and gas, but there's some potential purpose for it. It goes in that category. Everything else we're looking at, that is a producing or formerly producing well, is it producing oil and gas? If so, how much? Is it not producing oil and gas? If so, for how long has it not been producing oil and gas? And so there is no direct translation. You could imagine for a given state like Colorado, you could think about it in the same way. You could look at Colorado. They do give production information for their wells, and you could say who's producing, who's not producing, and what in what amounts. That would be a relevant way of dealing with that. Let's see. Have you had any initial feedback from oil companies identified in the database, example, challenging the cost assumptions for or data accuracy? Great question. So no, not from companies. And I think there's a couple things here. So data accuracy. Let's start there. So the data we have is from Inveris. We have every reason to believe that the inputs we get from Inveris, which is essentially the number of wells, and then where they have it, well depth information, comes from state databases primarily, but not exclusively. There have been instances where Inveris is going through a cleanup process, has removed some wells. I believe that happened in Texas, which reflects why we've had a lower estimate there because there's less wells in the database. But we largely leave that to data provider. I would just say many in industry use Inveris, subscribe to Inveris. And so I do think that there's a significant issue there. We have had people criticize our liability estimates. And I should say a few things about that. So the first is that when we're talking about very shallow wells, our estimates are in the tens of thousands of dollars. They're not $200,000, $300,000. We do think those are cheaper to plug. And the model that we use, that was reflected in it as well. I would say there's probably not a lot of disagreement at the bottom end for these shallow wells, easy to get to. I should note, however, even those shallow wells, if, for example, they're in the middle of Los Angeles or they're middle of a suburb outside of Denver, those are probably going to be more expensive, and we're not accounting for issues like that. Similarly, if a well's casing in integrity has been destroyed, then you're going to see much higher costs there as well, and we are not factoring that in at all. But the second thing I would say, when you get to deeper wells, I think what's important is when you look at regulators who are actually trying to act in this situation and address this problem, what are they doing? So for example, Lynn Helms, who runs the NDIC in North Dakota that oversees these issues, basically has said, he's indicated that when they've been requiring single well bonds for inactive wells, over the last 5 years, the average single well bond in that state is about $180,000, which is more money than the average plug-in cost we estimate for the state of North Dakota. Okay, that's one thing. Second is right now, Colorado's undergoing a rulemaking. They assume on average a plug-in cost of about $85,000 and then $200,000 per well for reclamation and remediation efforts. Okay, so for a total bill of $285,000. So I think that in these states you see that. Now you see, Railroad Commission, for example, looks at this as a $20,000, $30,000 problem, something like that per well. But their own data doesn't really even fully substantiate that. So I think that what you see is where people are addressing the issue, they're getting real about the numbers, and the numbers look more like what we have in this than anything else. But the last thing I'd note about this is, if you look at, I believe we had this in its closing time, that was where, no, it was in, pardon me, it was in Billion Dollar Orphan. So the report we did in September, we said, well, let's assume that every well only costs $30,000 to plug. The reality is there's still not enough bonding for it. There's still not because of the blanket bonds. So in a sense, it's almost a red herring. The reality is what we already know is that there is not enough money that's being set aside to deal with this problem, even if it's an incredibly small problem that some suggest it is. Okay, let's see. Let's go to the next one. Is there data on greenhouse gases leaking from abandoned wells specifically? Yes, it's not something that we have focused on too much. There are some studies out there from Amy Townsend Small and from Dr. Mary Kang, and both of them have looked at this, and they're beginning to look at this at places across the country. I would refer you to them. Similarly, on greenhouse gas emissions, I would further we have it focused completely on that. I will say the EPA, has looked at this, and I think if I recall, it was something like 8 million tons of CO2e from abandoned wells. They've started to focus on this as a emission source in the country. So pretty, obviously increasing attention is being drawn to that. Does having a national bond free the driller from buying a state bond? Nope, it does not. The national bond from the federal government just applies to the ones on federal land. How financially stable are the companies behind the bond? If they were called on to pay up, could they? Great question. The reality is these surety bond companies typically are a separate subsidiary, often of a much larger insurer, but they're focused on this. I don't think that has really been tested, to be honest with you. And it is a question that, if it is tested, will be one that will land in the laps of state insurance commissioners as they are responsible for overseeing that. It's a very good question. We've thought about research on this, but just have not done that. Is there any data about company financial strength in the database? Okay, Greg's answering that one. I think. Well, there's okay. Yeah. Let's see. In your opinion, why wasn't Colorado involved in the extraction bankruptcy? It's hard to say. I will say I used to be involved in bankruptcies on environmental issues for the state of New York. It is a complicated thing. Strategically, states are have to think about whether they want to be involved or whether they think the liabilities will still be there at the end, i.e. there'll still be someone that can have to address them after the fact. Yeah, so hard to answer that question. Let's see.
Hi, Rob. There's 2 hands up.
Oh, I cannot see the hands. Thank you.
I'm going to allow you to talk.
Oh, hey, this is Ankit. I had actually asked my question in the chat as well. And I'm actually reading through your database, and I see you kind of answer it. My question was, how do you estimated the depth per foot? Because your liabilities cost is based on you look at the depth of each well. So how do you estimate the cost per foot? Sorry, that's what I mean to say.
Yeah, no, great question. Yeah, so basically, right, so the depth information we get from Inveris, and so the depth per foot comes from an algorithm that we have built that is based on actual plugging and abandonment data from a data set from Australia. So the reason that we use it is because of the richness of the data set. It involved contemporaneous drilling and plugging activity, and every cost was sort of isolated for the plugging activity. And these are wells where you don't have to worry about issues about degradation over time because they were plugged essentially immediately. So it was part of various drilling expeditions where you had drilling, dry holes, and then a plug, basically, or something that was pretty contemporaneous, right? Sometimes they had to go back to the next season, but very, very contemporaneous. And so looking at that data set, we essentially drew the curve through the data points, and that's what's informed our cost estimates per foot. Is there anyone else, Helena?
Yes.
Questions?
There's
please.
one more hand, Rob.
Wonderful.
And Kate, I'm just going to turn you on now.
Oh, great. Thank you so much. Sorry, I guess it got missed in the chat. My question was about, is there a safer way that bonds can be collected from these operators without tipping them into bankruptcy? One of the problems that Colorado is facing with its new bond rulemaking is that it's so late in the game, and we have so many, not just the idle wells, but I think the last estimate was something like over 30,000 stripper wells in the state that are producing an average of only 1,000 barrels of oil per year. They're barely hitting the break-even cost. So I know our regulators are very concerned about tipping operators suddenly into bankruptcy, but it's sort of a catch-22. And I was wondering if you had any ideas about any safer ways to collect these types of bonds without suddenly dumping a bunch of orphan wells on the state.
Yeah, it's a great question. So, I think the first thing that people have to do is think about these really in 3 kind of categories of wells. So the first category of well, the ones on the ends are actually kind of the easy ones to deal with, and they should be dealt with right away, regardless of how you solve the middle piece. So you've got the beginning of life wells, right? They've just started production or they're going to be permitted. You should just go to full bonding. Then the operators can make the rational choice whether it is worth pursuing drilling that well or not. Industry will often estimate that at the beginning of the life of the project, you might have 5% of the capex that's spent on the project. In addition, that would be the cost of plugging and abandoning that well. So if it costs $6 million to drill, a shale well, you'd be expecting about $300,000 in cost. That should be manageable when you're looking forward to production that's already coming online. The other end of the spectrum that's easy to deal with, in a sense, is the orphaned wells. So these wells are already, they're already gone. The industry is socializing that cost to taxpayers and consumers. It's going to be very hard to get blood out of a turnip there, unless the state, and some do, have liability regimes that allow them to go after predecessors. So note that might be a useful thing to have, very common in environmental regulation. But if they don't have that, then they're going to need to find a way to socialize those costs. That's going to have to be socialized either across industry or wider across society at large. But there isn't going to be a real way to introduce incentives there. So then it comes to the complicated middle part that you're talking about. And even here, there's a spectrum, right? If you have a well that's not a stripper, that's producing 15 barrels of oil a day, right? They're still producing several thousand barrels of oil in a year. And the question is, right now, some of that is going as profit to the operator of that well. But if the argument is they can't afford to pay for that, liability, right? Why should the profits be getting taken from that right now? We wouldn't in another context say, well, if taxes are too expensive, don't pay that, just keep the money. So I think that there's going to have to be some solutions. So maybe you want to say, okay, you need to start a sinking fund, right? Or maybe you want to say, okay, this is what we look at, and this is what they introduced in Canada, but then watered down to the point that it's somewhat diluted, is this notion of economic limit. At some point, you should be redirecting some of this money that's being taken as a profit into the legal obligation you already have to close this well. So that's going to take some numbers and thinking about that. But conceptually, I think the focus is on that middle piece. How do you start to save for retirement now, instead of saying, oh, we didn't save already, let's continue to not save for retirement as we approach it. Okay, so I do see a couple questions here again, and then Helena, please let me know if other people, I can't see the hand raised, so you have to let me know. So do you have data on small operators that you excluded? We do have data on small operators that we excluded. We focused on just kind of the largest operators, but if they're in the Inverse database, we do have it. I'm happy to take questions about that. You can reach out to us individually. Question on legal liability. Haven't looked into that enough to be able to tell you. Let's see. Good. And let's see. I think that is it. Are there any other questions, Helena?
No, no more hands.
Okay, wonderful. Well, thank you all for joining today's session, and especially thank you to those of you who were going to join us a couple of weeks ago, but we decided that in the middle of a power outage, it wasn't the best time for a webinar. So appreciate your patience with that. And again, I really do hope that you all take a look at the database, you think about it, and if there are things that you think that would be useful to you, please let us know. We're always looking to really improve and make this a useful tool for the public at large. Thank you very much.